So again, welcome to this financial aid and college scholarship presentation. Just a little bit of background about me. I've been an independent college consultant for 16 years and have worked with hundreds of students and parents on the college process. Also, I work with families all across the United States and internationally as well. And my clients earn hundreds of thousands of college scholarship dollars every year, and they attend great colleges. And the reason being is because we work together. It's a collaboration of trying to help them. Also, I'm a guest speaker at national, regional, state, and local events. So again, I'm glad that you're here today. And finally, I'm also a best-selling author of a book called The College Entrance Game Plan, Your Comprehensive Guide to Collecting, Organizing, and Funding College. So that's a little bit about me. Here's that book that I was talking about. It's actually available on Amazon.com if you are interested. And again, it's a thorough read as far as trying to help you navigate your way through the college process. Reminder, feel free to ask questions. You can put those into the chat box and I will try to get to all of them before or at the very end. That's where I take my Q&A session. And also, feel free to schedule a discovery meeting with me today. It's real simple. If you have additional questions that you are still trying to figure out on this whole college process, you can go to collegeandbeyondllc.com and click on the Let's Chat button, and that'll allow you to be able to schedule that time to meet with me. Okay, so let's get started. Financial aid. It's really where everything starts, and it's the #1 topic that everybody talks about out there. But I think you need to know the nitty-gritty about this. And so I'm going to dive into this heavy duty so that you understand the intricacies of the way that it works. And then we're also going to talk about scholarships as well and other funding vehicles. But so you need to know that financial aid comes in two forms. There's the free money and there's the self-help. Now, the free money, of course, is what we all hope that our students are going to get, which is the scholarships or grants. And that's, of course, the scholarships are based on a variety of different things. We'll dive in it a little bit more later, but just know this, there are merit-based and need-based scholarships. And then with the grants, those are all need-based grants. And then the self-help is what ends up being a lot of the financial aid that's offered to families, which is loans or work study. Now, work study is a part-time job that a student gets on campus. The money is actually paid directly to them, but they can use it to offset other miscellaneous expenses and things that they may have. So just keep that in mind. That is an option that some colleges do set up. And students can also at times apply for other campus jobs as well, like resident assistants and things like that. But the question you have to ask yourself is, which type of aid are you going to receive, or is your family going to receive? And how are you going to qualify for this financial aid? Well, I've got the answer to that. You see, for the federal side of things, it all starts with this thing called the FAFSA, the Free Application for Federal Student Aid. And a couple of things about that. It is used to calculate the federal methodology, expected family contribution, which we'll dive into in just a minute. But this is where it all starts, is with this form. In addition to that, I'm going to ask you along the way here some true or false questions. So the very first question is this: all colleges require the FAFSA to be submitted. What do you think? Is that the case? Well, the answer is no. The reality is none of these colleges on this list here require the FAFSA. And the reason they don't is because they don't want to be told how to spend their money or educate their students on campus. And so for that reason, they do not take any federal aid. You may see some schools on here that you recognize, schools like Hillsdale College, for example, in Michigan, and some others. But again, these schools do not take the FAFSA. Another true or false question: our family makes too much money to qualify for financial aid. Now, you may think this, and to some extent, you may be right. But the truth of the matter is that every family can indeed qualify for financial aid. Again, it comes back to the question of what type are you going to qualify for? So when we're dealing with the FAFSA, the thing that you have to know is that it opens on October the 1st, notice of the senior year. That's when we're actually going to have you complete this form. Now, you do not want to complete it before then. because if you do, what you're actually going to do is that you're applying for the spring of your son or daughter's senior year in high school. And we sure don't want you to do that unless they're planning on going to school at that time. And they're also going to use this thing called prior. And you have to understand the details about this. And so we're going to talk about that right now. You see, prior is where the IRS is actually going to capture your tax return from 2 years prior. And so for students, for example, that are graduating here in May or June of 2022, you're actually using your 2020 tax return. And so in the future, you can see how this all works as it continues to be 2 years back. Now, why is this such a big deal? Well, if you're a family who was hoping to do some strategic planning with maybe your financial advisor, or maybe you own a business on the side or some other things that you're doing, and we're hoping to reduce your income or assets, then just realize that, again, from an income standpoint, they're always going to be looking at 2 years back. And so that's why when it comes to financial aid, by the time your student starts their junior year, you would have already fulfilled completing your tax returns that would have any impact on them. And of course, to get to the FAFSA website, you go to fafsa.ed.gov. And that's easy enough to do and gives you the ability to go in there and work on this document. But again, not until after October the 1st of the senior year. Now, how does divorce impact financial aid? Let's face it, about 50% of our population is divorced, and it does indeed have an impact. There's a couple of things. You need to identify which parent is considered the custodial parent. And that's the parent with whom the student lives at least 51% of the time. However, what if you've got joint custody and you're trying your best to balance it out, as far as the student spending equal time? Then many families, what they will do in this case is that they'll go with whichever parent makes the lower amount of income and assets. Now, that could be a dicey conversation if there is not a real good working relationship between exes, and I get that, but I'm just telling you that it's a big deal. Now, this is the way it is now, but you have to know that in the 2024-2025 school year, there are some really big changes coming to the way the financial aid form considers divorced families. You see, at that case, it doesn't matter whom the student lives with 51% of the time. The deciding factor is going to be which parent provides the most financial benefit to the child. And that can be a telltale sign, because in many cases, if one parent makes more money, has more savings, they likely are indeed paying more for that child. So please keep that in mind. Again, that's not currently the situation, but because your kids will be in school likely by that point in time, this will impact you if you are a divorced family. So true or false? If parents are divorced, you do not need to include a step-parent's income and savings. What do you think? Well, unfortunately, the answer is that a step-parent's income and assets must be included if the FAFSA is completed. And that's regardless, by the way, of whether you've got a prenuptial agreement or not. I have this conversation all the time where one parent thinks that the step-parent should not have to pay for college, and I understand that. But the truth of the matter is the federal government doesn't care. They still expect you to complete this. Now, where the gray area may come into play with this is with the CSS profile, because if a college only uses the CSS profile to determine how much they're expecting you to pay, then in that case, it's possible that a step-parent's income could indeed be left off the equation. Interesting conversation that you may want to have with those schools in the future. So I also wanted to give you some idea of the biggest FAFSA mistakes that I see families make. First, having the wrong person complete the forms. Yep, I'm telling you, every year I see this happen where mom or dad had the best of intentions, but then they turned around and they did things like this. They mixed up the student and parent information. In other words, they didn't read what the page said that they were supposed to be completing. Maybe they added home equity and the value of a family business to your investment totals. And in that particular case, you jacked up your expected family contribution, when in reality, with FAFSA, you do not need to include home equity or those businesses unless it has over 100 employees. Also, they will make the mistake of adding the value of retirement plans to the investments. So things like your 401k plan or a 403b SEPs or simples. That's right. In other words, you do not, with the free application for federal student aid, need to list the current value sitting in that 401k plan on your financial aid forms, but it happens every single year where families do that. Also, Roth IRAs do not need to be included, or the value. Qualified and non-qualified annuities do not need to be included. Cash value life insurance does not need to be included. So the point is, stay away from these types of things. Don't put yourself into a situation where you inadvertently give them more information that they're asking for. So read the questions carefully and only give them the financial details they request, no more. One of the questions that comes up in it is that it asks about your net worth. And the problem is families start adding everything up, when in reality, if you read the details, read the little question mark that comes up, it tells you exactly what you should or should not list. So be careful. Now, in addition to that, we're going to talk about now the CSS profile. So that's the FAFSA. And by the way, families make similar mistakes with this form as well. But here's what you do need to know about the CSS profile. First of all, it's the institutional methodology. So there's the federal methodology that we already talked about. Now we've got the institutional. And it's used by about 400 colleges and organizations out there, in addition to having to complete the FAFSA, okay? And it also opens on October the 1st of the senior year. So as you are making your plans and you're looking at colleges, you do need to know whether the college requires both of these documents or just the FAFSA. Now, a couple of things that come into play with this. Number one, they very well may take home equity into consideration. So, unlike the federal methodology, this one does. And so, in this case, you're going to have to be real specific about what you think your home is worth. Also, they may ask for sibling assets and even vehicle values. That's right. For example, Harvard University will ask you what make, model, and value you attribute to the vehicles that you drive. With the divorced family, they are going to ask not only for income and assets for one side of the family, but also for both sides, unless, again, it's one of these situations where the school will exclude the step-parent. And that's something you would have to ask them before you complete the forms. Also, just so that you know, there are a small handful of colleges out there that on the question of custodial versus non-custodial parent may allow you to keep the non-custodial parent's information off the equation. So do the research and ask the questions. Now, they also use this thing called an IDOC, and that's where they're going to have you upload things like your tax returns, maybe some asset statements, and those non-custodial documents that I was just talking about. So again, you've got to do your research and make sure that you know what they're looking for. And then business owners must always add back in losses and depreciation, and for that matter, a value of the business. Now, why do I mention this whole loss and depreciation thing? Well, believe it or not, some families can take significant deductions on their tax return. And from the federal methodology, they qualify for all kinds of need-based aid. But that's not the case with the CSS profile. You see, with this particular document, they're going to force you to add that back in, which means that those negatives suddenly become a positive. And here's where you would go to get the CSS profile. Ironically, this financial aid form is located within the collegeboard.org's website, which is the same place where students do their advanced placement tests, where they register for those things, where they do CLEP exams. I mean, all kinds of dynamics are connected to the College Board. So there's also an additional 24 colleges out there, which are by far the most selective colleges, and they're called the 568 Presidents Club. Now, you may have heard of these schools because they've been in the news within the last month or so, because there's some lawsuit going on right now based on collusion of where they are comparing financial aid awards on students. Not sure where that's going to go, but those are the exact same schools that are part of this group. They will take home equity into consideration in most of the cases. There are some exceptions, like schools like Stanford do not. They do ask for sibling assets and vehicle values again. With a divorced family, they're going to get both sides of the equation. So think of it this way: mom and dad are divorced, mom and dad are remarried. Now we've got 4 potential income and asset values coming into the equation. They again use the same IDOC tax returns, and they still look for a business value and add back those losses. So again, it acts very, very similar, but in some cases it's a little different than the regular CSS profile institutional colleges. Now, you do need to know that some colleges also have their own form that they expect you to complete. For example, in the state of Kentucky, Center College has a separate financial aid document that needs to be completed. In that case, they only take the FAFSA. They do not take the CSS profile. And so it's all about making sure, again, that you're crossing all your I's and dotting, listen to me, crossing your T's and dotting your I's when it comes to what you need to share with the schools. And again, these open up on October 1st of the senior year. Another true or false question. We only need to fill out the FAFSA and the CSS profile one time. What do you think? Well, folks, I wish it were that easy, but the truth is you have to complete these forms every year unless, and here's where the unless comes into play. You know, with those schools that require both documents, it is sometimes a case, and I'll give you an example of Princeton University, where they say you have to do both the first year, but then the second year, all you have to complete and submit to us is the FAFSA. And so that's a win, you know, because it means that you don't have to give all those additional details. And by the way, just so we're clear on this, the CSS profile is very intrusive when it comes to your financial information. They're going to ask you lots of questions that you do not get asked on the FAFSA. So just be prepared for that. But again, you could run into a winning situation like what Princeton does. Another true or false. A student can decide to be independent for financial aid purposes at any time. What do you think? I mean, you know, it'd be great, right? You get your son or daughter through high school and suddenly it's like, okay, you're washing your hands of it. It's 100% on them. Well, unfortunately, that's not the way that it works. You see, your student is going to be considered dependent until they either reach the age of 24 by December 31st of that given year, or they can answer yes to one of 10 questions. And I want to give you an example of what these questions might be. They are in the military, they're married, they have a child or other dependent, they are homeless, they are emancipated. And by the way, just before you get all excited about emancipating your son or daughter, just realize that was one of the other sticking points that happened here not too long ago, within the last 5 years, where it was discovered that there were families in the Chicago area, wealthier families, who were taking their kids and they were going to court and they were emancipating them down to some relative who didn't have the same income and assets that they had, or even some stranger, a friend of the family, for the sheer benefit of trying to qualify them for need-based aid. The problem is they all picked the same college. And so it didn't take long before these folks in the college financial aid officers were starting to notice this trend of these students who were coming in emancipated. And then they started to connect the dots back to the legal firm and then back to the advisor that was suggesting to them that they do all this. Do not do that. You have to know that there is a penalty of both jail time and a financial penalty if you take advantage, you know, if you lie on the financial aid forms or if you lie in the process. So don't cross the line. So what should you do before you complete these forms? Well, there's a couple of things. I personally think that it really all starts with knowing your EFC. And your EFC is your expected family contribution. Now, everybody that's on this presentation right now, it's important that you run these numbers, that you know what the colleges are going to expect you, mom and dad, to write a check to send your son or daughter to college. Because there is a number out there, whether they're going to a community college or going to an Ivy League school, it doesn't matter. And so let's break this thing down. Let's talk about it. So the very first thing is the parent's income, the parent's assets, the student's income, and the student's assets. So let's dive into each of these individually. So first of all, with the parent's income, notice it's the adjusted gross income from the tax return less an income allowance. And so what that means is that you're going to your tax return. Remember, they're looking at the tax return from 2 years prior to when your son or daughter is graduating, from high school. And so what this income protection allowance does is this. It says that, for example, if you have a family of 4 and 1 child in college, you can make $28,580. And you have to know that every dollar above that counts at anywhere from 22 to 47% against financial aid. That's why income alone is the #1 contributor to your expected family contribution. Then we're dealing with your parent assets. Notice it says it's 5.64% of non-retirement assets, less an allowance based on the age of the oldest parent. So think of non-retirement assets. That's cash, checking, savings, money markets, CDs, EE savings bonds, individual stocks and bonds. In other words, anything that you've got outside of your retirement vehicle is susceptible to this 5.64%. And they do give you this allowance. However, unfortunately, the allowance is super duper tiny. In fact, if you are 56 years of age like I am, and you are married, you can have $4,600 in those various vehicles. And so again, once we subtract that off, every other dollar counts at 5.64% against financial aid. Now, look, I'll be the first one to tell you, I would rather that you save something for college than not, but just realize that it will count at that 5.64%. So again, $4,600 is all that you get to have set aside as far as any kind of protected allowance that they provide. Again, things that come into play: cash, checking, and savings, CDs, money markets, stocks, bonds, mutual funds, even ETFs. 529 plans, by the way, are considered an asset of the parents, as well as education savings accounts, or education IRAs, as they're sometimes called. So, and that's a good thing, by the way, folks. It's much better to pay 5.64% compared to what you're going to see in a minute that you have to pay on all student assets. Also, rental or investment properties will indeed count unless those properties are in an LLC, in other words, in a business arrangement. The business value, if it's not a family-owned business, and then farm or land value could also come into play here, especially if you own a farm and it's, and you're working it, it's actually producing income. And last but not least is the trust values. If you happen to have a trust, or for that matter, if your children have trust, it will indeed be counted in the equation. So the next thing is the student's income. Notice it's earnings over $6,970 or assessed at 50 cents on the dollar. So here's what that means. Your sons or daughters can go out there and get a job. And in fact, even in the current environment where the minimum wage has been bumped significantly, and companies are paying students a reasonable wage now, they can still earn quite a bit before it has any impact on financial aid. But once you cross that magic number, it is 50 cents on the dollar against it. And then finally, it's students' assets. And notice it says all assets are assessed at 20%. That's right, folks. That means that if your son or daughter has any money, let's say they've got $10,000 sitting in savings, that's $2,000 worth of financial aid that they will not receive because of their savings. Until that money is spent down, it's going to count against them each and every year. And just so that you know, when it comes to the institutional and consensus colleges, specifically the ones that use the CSS profile, they have an expectation that your son or daughter is going to contribute to their education to the tune of almost $2,400 anyway. And so, again, it's important that you realize these numbers. Income is by far the biggest, parents' income in particular, is the biggest contributor to your expected family contribution. I have seen some situations where students have significant money set aside, or parents have significant non-retirement assets set aside that will indeed impact you. So run your EFC ASAP. And what you also need to do is that in the future, when your son or daughter has identified the colleges that they're going to apply to, you need to run their net price calculators. You see, back to the whole conversation about the FAFSA, every single school that has or takes federal financial aid must have a net price calculator on their website. However, you need to know that they are not all created equally. Some are terrific and really do a great job of getting you almost down to the dime as far as what it might cost to send your kids there. Others are terrible because all they do is they give you a range. For example, Georgetown University or American University actually is a terrible calculator. And ironically, the template that they're using is the federal systems calculator. So just amazing stuff. So make sure that you do your homework. So here's another easy way for you all to run the EFC. You see, if you go to my website right now, which is collegeandbeyondllc.com, you will see that there's a Get Your Free College Money Report listed. And what's interesting about this is if you click the button and then enter in your financial details, and remember this, junk in gives you junk out. So if you're going to go ahead and put good, accurate information in, you'll get a good, accurate expected family contribution on the back end. Plus, you can put in up to 3 colleges and also details about your student when it comes to their test scores, if you have those, and their GPA. And it will give you an idea of what it's going to cost to send your son or daughter to those 3 colleges. It's just a great free tool that's available, like I said, on my website that you can use. And you'll see it again as soon as you go to the top of the, or right to the first page. Okay, true or false? It's better not to save money for college so that you qualify for more aid. I think we've already talked about this, because the fact is it's much better that you save some money, because again, the worst case scenario is that it's going to count at 5.64% from the federal methodology and 6% for the institutional consensus methodology. But having something, of course, is better than nothing, in particular with the ever increasing cost of college. I mean, it's continuing to go up, and you have to believe that inflation will also impact college the same way that's impacting everything else that we're buying right now. So I also want you to understand the financial aid formula. So think of it this way. You've now calculated your expected family contribution. Now we need to understand what the colleges are going to do. You see, it all comes down to this: COA minus EFC equals financial need. And what that is that the COA is the cost of attendance for a college minus the expected family contribution. So think of it this way. If a college is $50,000 and your expected family contribution is $30,000, then the financial need is going to be $20,000. If, on the other hand, the cost of attendance is $50,000 and your expected family contribution is $70,000, then of course there is no financial need. The expectation there would be that you're going to write a check to send your son or daughter to that school, full freight or full cost. The only exception might be that your kids could potentially get some scholarship money or merit aid. But know this, and that's why I'm really giving you this illustration, is that just because they tell you that your expected family contribution is what it is, does not mean that it meets your family's affordability. And so proceed with caution. You've got to make sure that when you're looking at colleges with your kids, that you're running the numbers so that you don't put yourself in a no-win situation with them. So again, cost of attendance is broken down this way. It's based on the tuition for the school, the mandatory fees, room and board, books, transportation costs, and miscellaneous expenses. Now, I wish I could tell you that all of these numbers are always accurate, but one of the things that you have to know is that unfortunately, some schools list these things, and in other cases, they don't. They may list tuition and fees. Some of them don't even include books, transportation, and so forth. So it's very much a process of understanding what it is that they're going to list. And we're going to take a look at some details here in a second for what's called a financial aid award letter. So that's why, in my opinion, because of this situation, you need to make sure that you guys absolutely have other schools that are on the table, that fit your student, that are financially the right fit, academically the right fit, socially, geographically, and if it turns out that they're into athletics or artistically talented, that it's going to fit them as well. I promise you, if it fits all 4 of the top pillars and or the bottom 2 as well, that your student is going to go someplace where they're going to thrive and survive, not someplace where they're going to struggle. And they could struggle financially, they could struggle academically, they could struggle socially, or they could struggle because of the distance. And so we don't want to put them into that kind of a situation. So now we're going to talk about these financial aid award letters, because you have to know, again, you've submitted your financial aid forms, and you've gotten from that the expected family contribution. In other words, the colleges have determined what that's going to be. So now they're going to reward your student. Well, the thing is, there are terrible financial aid award letters and great award letters. I'm going to show you both. What's terrible about this one, you can see right off the top, there's limited costs that they've shared with you. In addition to that, they've mixed everything up down here when it comes to financial aid, and there's a ton of acronyms that you may not even recognize or know what they mean. And so it's deceptively low. It says that the school, which is $41,200, is only going to cost you $9,950, right? Well, the truth of the matter is it looks like that's the amount that you're going to pay, but what about all the loans that are hidden in this equation? Things like the $12,200 Parent Plus L, which stands for Parent Plus loan, that's here. Or the federal subsidized Stafford loan of $3,500 that's in there. Those are the kinds of things that can throw families. And unfortunately, I find it bad that these colleges stick Parent Plus loans in there and truly consider it part of your funding situation. Here's an example of a better financial aid award letter. You're going to notice everything's broken down off the top, okay? And then in addition to that, they also have set aside the gift aid by itself. So it's actually split out by itself, which gives you then a net price. So we started with $58,200. We're down to $46,650. And then finally down here at the bottom, they've carved out the loan options that they're suggesting that you use to help pay for college. And so again, a much, much clearer, better example of what it's going to take to be able to pay for college. I love this transparency. And so now I want to give you an example of what one of these looks like. So this is Miami University, which is in Ohio. It's a public university. This is brand new. This just came out back here in February for one of my students. Their information has been removed to protect their identity, but I want you to notice what the school did. So they're giving you the direct costs. In other words, things like the institutional fees, the general fees, career development fees, housing and meals. Who would have thought there'd be so many fees, right? Then we've got indirect fees and costs that are down here, books and supplies, transportation, and miscellaneous expenses. And the reason those are indirect, by the way, is because there's no way to know exactly what the student is going to spend on their books, on their travel back and forth, or those other expenses, but they're trying to give you at least some sense of what it might be. Then we go over here, and you can see that at the top, the student received a $10,000 scholarship. And so what they do is that they bring that information down here, and they show that the direct costs are $33,188. They take off the $10,000, and so that shows that there's still $23,188 that needs to be covered. And you'll notice that currently the loans are listed as 0. So that could be that the student takes out the loan amount that they need, or maybe they don't. But that's, again, the shortfall. That does not include, however, the indirect expenses, which we know will also have to be paid. So how's your family going to pay for college? Well, here's what I can tell you. These are the 5 sources of money. There's free money, saved money, earned money, loaned money, and military money. And we're going to talk about each of these just briefly here in our presentation. So when it comes to the free money, the one place that everybody goes to is, of course, college scholarships. And I think we can all agree, getting that free scholarship money is a great, great situation. And so scholarships come in 3 different flavors. There's merit-based, need-based, and service-based. Service-based being either because you've done a ton, your students have done a ton of community service in their neighborhoods, or service to our country. There's also, of course, need-based, based on a financial need, which came right off the financial aid forms being completed. And then merit-based right off the top is based on their talent, their athletic ability, or their academics. That's where that merit money comes from. And it's rewarded or given to students based on either the colleges themselves or outside private sources. So what does it take to qualify for these scholarships? Well, here's the formula that you need to know. Usually it's based on an unweighted GPA. Now, there are some exceptions. For example, Miami University that I just showed you uses a weighted GPA. And by the way, in many cases, colleges, when they're especially giving out their big money, may recalculate the GPA for the student. And they're looking at their core classes, their math, their science, their English, their social studies, and maybe even a foreign language. It's also going to be ACT or SAT, but hey, let's not forget, we're also in this test optional world right now. You know, the fact is, there are some schools that are changing from this. In fact, many of the Florida schools and the Georgia schools, and even like the UNC Chapel Hill in North Carolina recently went back to requiring tests. In the California, of course, different situation. I mean, the test of actually, or the colleges have actually gone test blind, which personally I think is a terrific thing. I hope that many, many schools in the future will continue to be test optional. And then there's extracurricular and the rigor of the curriculum that the student has taken. In other words, what are they doing? Are they taking the hardest AP classes, IB classes? Are they doing dual enrollment or early college programs? And in addition to that, what are they doing outside of the classroom? And that leads to the final piece, because you see, everybody understands the top of this formula. But the biggie is, what's going to make your students stand out from the rest of the crowd? You see, it's their hook. It's that one thing that they've done, or those two things that they've done exceptionally well in spite of the complications associated with COVID. And look, I know that COVID has compromised everything, when it comes to activities, when it comes to extracurricular activities, in particular, community service, all kinds of things. And we're just starting to get back to some sense of normalcy with some of those things. But I will tell you that these colleges still have an expectation to get the big money that you're doing something. In other words, a student can't be inactive. They really can't be reactive. They need to be proactive when it comes to this type of thing. And here are some examples of a hook. You may have a superstar athlete who's not going to have any trouble at all getting or catching the eye of a coach and then get money. Maybe a student started a foundation, or they even opened a business. I had some students, for example, who opened cookie making businesses and still have those going on. Maybe they've done years of research on a college lab. And by the way, in this day and age of virtual, that can be done. Maybe they've amassed tons of community service hours. One of my students this last year has written hundreds of cards to folks that are in nursing homes. Or maybe they wrote a book or anything that got published. In other words, they got them some notoriety. Or they started a club or community service organization at their school. In other words, things that they didn't have before that now they saw a need to fill. Again, folks, it all comes down to your student being proactive. What are they going to do to position themselves so that when they're reviewing the application, they stand out for all the right reasons? I promise you it makes a difference, and especially in this day and age of test optional. Now, you also need to know, though, that there are some colleges out there that do not give out any merit scholarships. Heck, it's hard enough just to get into them in the first place. And so these schools, and you're going to see the Ivies and the Ivy wannabes on here, right? The Cornells, the Princetons, the Harvards, the Yales, the Columbias. I mean, these are the schools, these are kind of the creme de la creme out there. And because of that, no merit scholarships. However, if a student does get accepted to these schools, they do give out need-based aid. In fact, Harvard has what they call the Harvard Promise, which says that if your family's income is below $120,000 per year, adjusted gross income, you can go to school there without any debt. As it grows from there, if your income grows or your asset amount grows from there, they do expect you to participate accordingly. But these schools definitely do have lots and lots of endowment money. In fact, what Harvard, I think, has $16 billion of money set aside. So they can surely give some of that away to help deserving students get into their school and pay for it. Now, how about private college scholarships? One of the things I will say to you is this: they are out there, and I have students that get these every year. But it all comes down to one important thing. It's not just about the research, but it's also about doing the work. Pursuing these types of things is like a part-time job. And in fact, I will tell you that on my website, there is a DIY course that families can employ that's all about helping students find those outside scholarships. And so I would encourage you to check that out. But the point again is, somebody's got to do the work. Somebody's got to be involved in searching for these scholarships and doing whatever they can to keep students involved in the process. Because mom and dad, in my opinion, you can't care more about this than your students do. So I want to share some of my favorite websites with you. Raise.me is an easy one. And the reason I say it's easy is because students get credit for what they're doing in high school with their grades and their test scores. Now, the catch on this is that you have to check with a college, because if they participate in Raise.me, that's one thing, but they're going to give you an either or proposition. Either the student's going to get the Raise.me scholarship, or they're going to get the scholarship from the college if a student qualifies for it, not both. One of my favorites here is Going Merry. What's nice about Going Merry is that it actually allows a student to go in and create a portfolio. And then based on that portfolio, you turn around and the student can apply for multiple scholarships. Often there's going to be an essay that's required to go along with it. There could also be additional letters of recommendation, a transcript that might have to be sent in, all those kinds of things. But I also like the fact that Going Merry bundles scholarship amounts together. So they'll take $500 from this foundation, $1,000 from over there. They'll bundle all this stuff together. The next thing you know, you've got a $5,000, $10,000, even $15,000 scholarship that a student can pursue. There's also Unigo, FastWeb. FastWeb is the granddaddy of them all. It's been around for years. College Board also has scholarship opportunities on there if you do certain things like use Khan Academy to prep for the SAT or use their scholarship search tool. Scholarship America has some great tools. Over on the right side, Tuition Funding Sources claims to be the largest database of scholarships. It's actually part of Wells Fargo Bank. Then there's CAPEX, which is scholarships both at the colleges as well as in the private sector. JLV Scholarships is awesome because it shows scholarships by month, by major, by interest. You've got places like Chegg Scholarships down there. Chegg, by the way, is a great resource if a student is looking at wanting to lease their books. Here's my point. Do you need to do all of these? No. But does your student have the ability to take some of these for a test drive and figure out which one they like and then pursue them? Absolutely. Get them to take some active role in their private scholarship search. Now, you do need to know that the months of February, March, and April, which is where we are right now, are the big months for scholarships, and especially for seniors in high school. You'll notice that there are scholarships available all through the year, which is true. It's just that they are lesser amounts. And in fact, there are scholarships that are offered to students. Heck, I've had students get scholarships as late as July the 1st, after they graduated from high school. So again, it's all about trying to set up a sequence, almost like a part-time job where the student is doing something proactively. And when it comes to saved and earned money, there's some different things that we can look at here. So let's start with mom and dad. First of all, how about the dollars that you're already spending on your student in high school, right? I mean, you've got maybe sports that you're covering or other activities that they're involved in. Maybe you've been able to save in 529 plans or education savings accounts. Maybe you could start a home-based business, or a stay-at-home parent suddenly goes back to work. Maybe that was your plan all along, that was going to happen. Maybe you're going to have to do some budgeting where you're going to have to crunch the numbers and see if you can come up with the right way to help pay for college. Or there could be some tax credits and deductions, things like the American Opportunity Tax Credit, which I refer to as a tax scholarship, where Uncle Sam, if your income is within a certain range, will help you by giving you a tax credit back. So you're actually going to get money that'll be reduced off your taxes. How about qualified distributions that come out of a Roth IRA if you've had it long enough? And, as long as you don't tap into the gain. In addition to that, life insurance cash values. Maybe you're going to tap into that, or that was part of your intention to do that. Be careful with this, by the way. There are some folks out there that use this as the be-all, end-all of funding college. I am not a huge fan of it, unless you absolutely are in a situation where you get significant assets and have a low income. And in that particular case, sometimes it makes sense to look at this as a strategy, but very rarely. Also, maybe you're going to use part of your inheritance that you're going to receive, to help pay for your son or daughter's education. Annuity distributions, if you're over the age of 59 and a half and aren't going to be penalized. Or a plus loan. Now, I'm putting plus loans on here because it's kind of almost a last resort thing where mom and dad, you're taking out a loan to help your son or daughter pay for college. There's also private parent loans that you can get out there from places like SoFi or Discover Card or any number of places, even credit unions. And then home equity loans. Some families still do this, but unfortunately, the IRS has knocked out the ability for you to tax deduct the interest if it's used for anything but home improvements. So college is no longer a legitimate use for that money to get that deduction. And then there's loans from your 401k plan. Now, I want to be very clear here. I am not a big fan of this at all. I understand that sometimes families tap into their 401k plans, but as we've just experienced with COVID, what happens if? What happens if you don't have the ability to go ahead and keep your job? Maybe you lose your job. Maybe you get sick and lose your job. Maybe you change jobs. You see, every time that happens, then you either have to repay those loans or that gets created as taxable gain on your tax return. And that taxable event then does what? It increases your income, which increases your expected family contribution. So like I said, I'm not a big fan of that. So proceed with caution. How about students? What can they do? Well, they can absolutely go for scholarships. Maybe they can use some of their own savings and gifts that they've collected through the years. They can do a co-op or a paid internship when they get to college. And I'm a huge fan of this, by the way, folks. In other words, if they're doing some engineering or business programs or whatever, where they can go out and make money while they're still going to school. Maybe they're going to get a part-time or full-time job or a work study, or as I mentioned earlier, become an RA, resident assistant, where they get their housing covered. Maybe they're going to do some unique stuff like some crowdfunding. Believe it or not, it is done out there. And or federal and student or private loans. So loans may become part of the solution, which is why we're going to go right into that, because you do need to understand that there are limitations when it comes to these things. So college loans. Well, the first thing that you need to know is that when it comes to the federal direct staffer loan, which is what it's called for the students, it is both subsidized or unsubsidized. So let me explain it. Subsidized means that based on your expected family contribution, you are need-based. You're a need-based family. And in that particular case, in your freshman year, you can get up to $3,500 of the total loan subsidized, meaning it's interest-free, while the student is in college. The sophomore year, it's up to $4,500. The junior and senior year, it's up to $5,500 each year. Now, unsubsidized means that the entire amount of the loan or a portion of it is being charged interest. And so that interest is charged from day one, and it will continue to accumulate on that loan in the future. So again, keep this in mind. This is part of the specifics, is that they could be subsidized or unsubsidized. It's all dependent upon your expected family contribution. So here's what we're talking about when we're looking at the loan amounts. As a freshman, it's $5,500 is the max. Sophomore, $6,500. Junior, $7,500. Senior, $7,500. And as a fifth year senior, you can get another $4,000 for a grand total of $31,000 plus interest. So again, just to be clear, of that $5,500, $3,500 of that amount could be subsidized, interest-free. The other $2,000, however, would be unsubsidized. And I know it can be confusing. I would encourage you to go back and maybe review this again, but just realize that 100% of that $5,500 could indeed be having interest charged on it. It depends on your expected family contribution. The only exception to this, as far as those maximums, is mom and dad, if you apply for a parent loan and you get turned down, in that case, they will give the student another $4,000 in the freshman and sophomore year and $5,000 in the junior and senior year. But that's it. That's the maximum amount of loans that a student can take out in their own name without a credit score and without a cosigner. After that, you're going to have to participate, or some other third party is going to have to participate in helping the student out. Now, parents, when you take out these plus loans, you need to know that you have the ability to fund up to the total remaining funding gap. Meaning, we looked at that award letter earlier. It was like $23,000. You could indeed take a loan for that full amount. And it is based on credit worthiness of the parent. And there are indeed debt to income limits. So you have to be aware of this. It's possible that down the road, you could max out the amount of money that you can take out. So again, proceed with caution and make sure that you know what you're getting into. True or false, parents can expect their son or daughter to pay off their plus loans. In other words, these parent loans. What do you think? Well, the truth is, parents, you're 100% responsible for those loans. So you really have no leverage. The only exception is if you're in a situation where the student could possibly go ahead and refinance all of their loans when they graduate from college. And if they have a really good credit score, then maybe you have the ability to take some of that money and roll that in there. But if not, you're stuck with it. And unless you've made some kind of an arrangement with your student, almost like a promissory note expectation, then you're going to have to make those payments while your student is making their payments. Now, I do want to also share with you the current interest rates on these loans. And so the direct subsidized or unsubsidized is at 3.73%. Just realize that if it's subsidized during the time that they're in college, as soon as they graduate, interest rates start being charged on that loan. So right now it's 3.73%. For the parent loans, it's at 6.28%. And those are fixed interest rates, by the way. In addition to that, there are loan origination fees on both of those loans. So for the student, it's at 1.057%. And for you parents, it's at 4.228%. That means if you took out a $10,000 loan, you're paying the federal government $422.80 to have had access to that loan. And that happens every single year that you take out a new loan. There's going to be a new loan origination fee on top of the interest that you're paying. So please, please do everything that you can to limit college debt. Back to the fact that you need to look at schools that are financially the right fit for your family. You know, you've got to just use that as the pillar of what you're doing when it comes to picking colleges. Last piece of the puzzle here is the military money. You know what? There are lots of ways for students to help or pay for college by doing things like the ROTC program, or maybe join the National Guard, or maybe they go to the academy. In addition to that, maybe they decide to enlist and then ultimately get out and use their GI benefits. It all comes down to what's the right fit. Is this an alternative? Absolutely. Have I seen it work with students? You better believe it. You know, the vast majority of colleges out there now have, for example, ROTC. There was a time, for example, where a number of the more selective colleges disband ROTC at their schools, but now they're back in motion. So again, another way for families to pay for college is to use the military to help provide funds. Bottom line, you need to have the college money talk now with your families, with your students, I should say, moms and dads. You need to talk about this. You need to take away all the myths when it comes to how you're going to approach this, because unfortunately what I see is this. I have families every single year at this time of the year who call me with an SOS call. We just didn't know. We didn't realize how expensive college was. And so, you know, they did not do a good job of picking the right school. So now they're paying the price. And the price is the fact that the only alternative is often taking out loans. So please do everything that you can to help your students make the right choices. And, you know, again, feel free to schedule a discovery meeting with me if you're just, you know, in one of those situations where you need some additional guidance and direction. All you have to do, again, is hit the Let's Chat button and it'll bring that up and it gives you the ability to do that. Okay. All right. So that's my presentation for today. I know I threw a lot at you, but I wanted to educate you as much as I could about financial aid and the scholarships and the other ways that you're going to pay for college. Does anybody have any questions for me? Let me see if we've got any here. So question is, if using a 529 plan and not planning on using student loans, why does this form need to be completed? Good question. So here's what you need to know. It really comes back to whether the college itself is expecting you to complete the financial aid forms, and specifically if you are hoping that your son or daughter is going to qualify for scholarships. You see, some colleges out there require you to do it. Like Georgia Tech, for example, has an expectation that you can complete at least the FAFSA, and that's so that you may or may not have your student qualify for merit aid. There's some other schools out there that do the same thing. If you've got 529 money, though, that you're planning on using, then good for you. I mean, congratulations on having that money saved for your child to go off to college. But again, do your research. That's the reason that you would sometimes do it. And by the way, I'm going to give you another reason. I will tell you, in my 16 years of being in this business, I unfortunately have seen cases where parents have died, parents have become disabled, parents have lost their jobs. And in those particular cases, you have to know that with many colleges, the expectation is, especially the private colleges, by the way, if you didn't complete the financial aid forms the first year, there's nothing that says that they'll give you financial aid in future years if you suddenly have a surprise that happens to you. The question is, does homeschooling affect eligibility in FAFSA? Absolutely not. Nope. Every single family across this nation of ours has the ability to complete the financial aid form and qualify for financial aid. So no limitations at all. Yeah. Any other questions from anybody? Feel free to throw them in the chat. I'll give it just a couple more minutes here and then we'll wrap up for the day. I really do appreciate you joining me, and I hope that you've learned a lot. Heck, if you just got a nugget or two that's going to help you, motivate your student to do things or help you as you guys are approaching this process, then it's a win-win. And so again, I hope this has been good in helping you as you navigate your way through this part of the process. Let's face it, college is expensive. It's continuing to be expensive. It will always be expensive. And so the more that you can do early, the better, so that you can make plans to help your son or daughter, again, go to a college where they thrive and have a great experience. But seeing no more questions, I want to thank you again for coming today and wish you the very best with your college process. Take care, everybody.